Over 40% of homeowners in parts of Florida are now sitting on negative equity, and some neighborhoods have seen property values drop faster than during the 2008 crash. Just a few years ago, homes were selling in hours. Bidding wars were normal. Prices seemed unstoppable. But in 2026, something has changed, and it's changing fast. For many families, what once felt like the safest investment of their lives is quietly turning into their biggest financial fear. Insurance bills are doubling. Buyers are backing out. Investors are disappearing. And in some communities, for sale signs are staying up longer than anyone expected. The question isn't just whether prices are falling, it's why they're falling so suddenly, and who might be next. Is this just a temporary slowdown, or the beginning of something much bigger? Today, we're breaking down the 10 hidden forces driving Florida's property value crash, and what every homeowner needs to know before it's too late. Number 1. Skyrocketing insurance costs are crushing homeowners. If you live in Florida, you've probably felt it already. That moment when your insurance renewal letter arrives and your stomach drops. In some areas, home insurance premiums have doubled or even tripled in just a few years. What used to cost $2,500 a year is now $7,000, $10,000, sometimes even more. And it's not just luxury beachfront homes. Ordinary middle-class neighborhoods are getting hit the hardest. So what's happening? Insurance companies are dealing with a surge in massive storm claims, rising construction costs, and increasing climate-related risks. As hurricanes grow stronger and flooding becomes more frequent, insurers are paying out billions. Some companies have already pulled out of Florida entirely, leaving fewer options and less competition. And when competition disappears, prices go up fast. The result? Homeowners are stuck paying higher premiums or scrambling to find coverage at all. Now here's where it gets serious. When insurance costs skyrocket, monthly housing expenses jump dramatically. Buyers calculate total costs, mortgage, taxes, and insurance combined. If that number becomes unaffordable, demand drops. And when demand drops, property values follow. It's not just about storms. It's about affordability. Imagine trying to sell your home, only to hear potential buyers say, the insurance is too expensive. That's happening right now across Florida. Some deals are falling apart during the inspection period because buyers can't secure affordable coverage. If you're a homeowner, now is the time to review your policy carefully. Shop around. Ask about wind mitigation discounts. Consider upgrades that reduce risk, like stronger roofing or impact windows. Because in today's market, insurance isn't just a bill, it's a major factor driving home values down. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 2. Stronger hurricanes and rising climate risk are scaring buyers away. Over the past decade, hurricanes hitting Florida haven't just become more frequent, they've become more intense, more destructive, and more expensive. We're talking about storms that rapidly strengthen within hours, dump historic levels of rain, and leave billions of dollars in damage behind. Scientists studying climate patterns have warned that warmer ocean temperatures fuel stronger storms. And unfortunately, Florida sits directly in that path. For buyers, this isn't just about watching the weather forecast. It's about long-term risk. When people consider purchasing a home today, they're asking different questions than they did 5 years ago. Instead of just asking about schools or commute times, they're asking, is this home in a storm surge zone? How high is it above sea level? How much will repairs cost after the next big storm? That shift in thinking changes everything. Banks and insurance companies are also paying close attention. Advanced climate risk models now project potential damage decades into the future. If a property is flagged as high risk, lenders may tighten conditions, and insurers may raise premiums even more. That makes financing harder and ownership more expensive. Picture this, a beautiful coastal home with palm trees swaying in the breeze, but buyers hesitate because they're imagining boarded-up windows and flooded streets. That hesitation lowers demand. And when demand softens, prices fall. For homeowners, this means preparation is no longer optional. Storm shutters, reinforced roofing, proper drainage systems. These upgrades don't just protect your home, they protect its value. Because in today's Florida market, climate risk isn't theoretical. It's influencing real buying decisions and reshaping property prices in 2026. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 3. Flood zone reclassification is quietly destroying home equity. Here's something most homeowners never think about, until it's too late. Flood maps change. And when they do, the financial impact can be immediate and brutal. Across Florida, updated flood zone maps are reclassifying thousands of properties into higher risk categories. Homes that were once considered low risk are suddenly labeled as special flood hazard areas. And that single change can cost homeowners thousands of dollars per year. Why is this happening? Government agencies regularly update flood maps based on new data: rising sea levels, heavier rainfall patterns, storm surge modeling, and historical flood events. As technology improves, so does risk detection. The problem is, better data often reveals greater danger. And when a home moves into a high-risk flood zone, lenders typically require flood insurance if there's a mortgage. That's not optional, it's mandatory. Now imagine you're trying to sell your house. A buyer is interested. Everything looks good. Then during the due diligence period, they discover the property was recently reclassified into a high-risk flood zone. Suddenly, their insurance quote jumps by several $1,000s per year. What happens next? Many buyers walk away. Others demand a lower price to offset the added cost. This shift doesn't just affect one homeowner, it affects entire neighborhoods. When multiple properties face higher flood insurance requirements, overall demand weakens. And as demand weakens, prices soften. If you own property in Florida, it's critical to check updated flood maps regularly. You can even challenge a classification if you believe it's incorrect by obtaining an elevation certificate. In 2026, a simple map update can wipe out years of built-up equity, and many homeowners don't see it coming until the value has already dropped. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 4. Investors are pulling out, and the short-term rental boom is fading. Just a few years ago, Florida was a magnet for real estate investors. Big investment firms were buying entire neighborhoods. Out-of-state buyers were scooping up properties for vacation rentals. Platforms like Airbnb made it look easy: buy a home, rent it short-term, and watch the cash flow roll in. Prices surged because demand seemed endless. But in 2026, that momentum is slowing down, fast. Many investors are quietly exiting the market. Why? Because the numbers no longer make sense. Higher insurance costs, rising property taxes, stricter local rental regulations, and increased competition have squeezed profit margins. In some cities, short-term rental occupancy rates have dropped as supply exploded. What once felt like a gold rush now feels overcrowded. Picture a neighborhood where half the homes were purchased as vacation rentals. When tourism dips or regulations tighten, those owners may rush to sell at the same time. That creates a wave of listings hitting the market all at once. And when supply rises quickly, prices naturally fall. Large institutional investors stepping back also sends a psychological signal. When the smart money slows down, smaller investors get nervous. Fewer investor purchases mean fewer bidding wars. And without bidding wars, prices cool. For homeowners, this shift matters more than it seems. Investors helped drive prices up during the boom. Now their absence is removing a key source of demand. If you're relying on rental income, consider diversifying or preparing for longer vacancy periods. Because in 2026, Florida's investor-driven surge is fading, and that retreat is putting real downward pressure on property values. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 5. Property taxes are rising, even as home values fall. Here's the frustrating part for many Florida homeowners. Even as property values begin to slide, property tax bills are still climbing. During the housing boom, local governments reassessed homes at much higher values. That meant higher tax revenue, and for cities and counties, it became the new normal. But now that prices are cooling, those tax assessments don't instantly adjust downward. In many areas, tax values lag behind real market conditions. So you could be looking at declining offers on your home while still paying taxes based on peak 2022 or 2023 valuations. That mismatch squeezes homeowners financially. Monthly expenses stay high, even as equity shrinks. And it doesn't stop there. Florida's rapid growth over the past decade led to expanded infrastructure, new roads, schools, emergency services. Those projects require funding. If local governments face budget pressure from slowing real estate transactions, they may rely even more heavily on property taxes to stabilize revenue. That can keep tax bills elevated even during a downturn. Now imagine you're a buyer comparing two states. In one state, property taxes are stable. In Florida, insurance is high and taxes are climbing. That combined cost affects affordability. When affordability drops, demand weakens, and when demand weakens, property values follow. Homeowners aren't powerless, though. You can review your property assessment annually and file an appeal if you believe it's too high. Make sure you're receiving any homestead exemptions you qualify for. Even small reductions can make a difference. In 2026, the issue isn't just falling home prices, it's the rising cost of ownership. And when the cost of owning climbs while values decline, that financial pressure pushes more people to sell, adding further strain to the market. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 6. High mortgage rates are freezing the buyer pool. One of the most powerful forces behind Florida's property value drop in 2026 isn't visible, but it's incredibly powerful. Mortgage rates. Just a few years ago, buyers were locking in loans at historically low rates, some below 3%. That cheap money fueled bidding wars and pushed prices higher at record speed. But today, the story is very different. With mortgage rates significantly higher, the cost of borrowing has surged. And here's what many people don't realize. Even a small rate increase can dramatically change affordability. For example, a $400,000 home financed at 3% might have felt manageable. But at 7% or higher, that same home could cost hundreds, sometimes over $1,000 more per month. For many families, that difference is a deal breaker. Now imagine you're a buyer doing the math. Higher insurance, higher taxes, and now a higher mortgage payment. Suddenly, the dream home feels out of reach. So what happens? Buyers pause. Some wait on the sidelines. Others lower their budgets. The pool of qualified buyers shrinks, and when fewer buyers compete, sellers lose pricing power. There's another layer to this. Homeowners who locked in ultra-low rates during the boom are hesitant to sell. Why give up a 3% mortgage for a 7% one? This creates a strange imbalance. Fewer move-up buyers entering the market, slowing overall activity. When transactions slow, price momentum weakens. For sellers, this means pricing realistically is crucial. Overpricing in a high-rate environment can leave your home sitting for months. For buyers, exploring rate buydowns or adjustable options might help improve affordability. In 2026, it's clear, high mortgage rates aren't just cooling demand, they're reshaping the entire Florida housing market. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 7. Condo safety laws and special assessments are triggering financial shockwaves. For many Florida homeowners, especially condo owners, 2026 has brought a new and unexpected financial burden: massive special assessments. After high-profile building safety concerns in recent years, state lawmakers introduced stricter structural inspection requirements and reserve funding rules for condominium associations. On paper, the goal is safety. But financially, the impact has been dramatic. Older condo buildings are now required to undergo detailed structural inspections and fully fund repair reserves. That means associations can no longer delay major maintenance projects like roof replacements, concrete restoration, or structural reinforcements. And when those repairs are overdue, the costs can be staggering. We're not talking about a few $100s. Some owners are receiving assessment notices for $20,000, $50,000, even $100,000 or more. Imagine opening a letter from your HOA demanding tens of thousands of dollars within months. For retirees on fixed incomes or middle-class families, that kind of surprise expense can be devastating. Some owners simply can't afford it, and they're forced to sell. When multiple units in the same building hit the market at once, prices start dropping quickly. Buyers are also more cautious now. Before making an offer, they're digging into HOA financial statements, reserve studies, and inspection reports. If a building looks financially unstable, many buyers walk away entirely. If you own a condo, reviewing your association's reserve funding and upcoming inspection requirements is critical. Ask about planned repairs. Prepare financially if possible. Because in 2026, condo regulations designed to protect safety are unintentionally putting heavy downward pressure on property values, especially in older buildings. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 8. Florida's population boom is slowing down. For years, Florida felt unstoppable. Thousands of new residents were moving in every single week. Retirees, remote workers, investors, everyone seemed to be heading south. That surge in population created powerful housing demand. More people meant more buyers. And more buyers meant rising prices. But in 2026, that growth is no longer accelerating at the same pace. Migration into Florida has slowed, and in some areas, it has even stabilized. The pandemic-era rush of remote workers relocating for sunshine and lower taxes has cooled. As return-to-office policies increase across the country, fewer people feel free to move wherever they want. Some who relocated during the boom are even reconsidering their decision due to rising living costs. Higher insurance premiums, rising property taxes, and increasing hurricane concerns are also influencing relocation decisions. When people compare total cost of living between states, Florida no longer looks as affordable as it once did. And affordability drives demand. Imagine a market that was expecting 1,000 new buyers, but only 700 show up. That gap matters. Builders constructed homes assuming rapid population growth would continue. Sellers priced their homes expecting steady inbound demand. When growth slows, supply begins to outpace demand. This shift doesn't mean people are fleeing Florida in massive numbers. It simply means the explosive growth phase has cooled. And when a housing market transitions from rapid expansion to slower, steadier growth, price appreciation often softens, or reverses. For homeowners, paying attention to migration trends in your specific region is crucial. Some cities may remain strong, while others cool faster. In 2026, it's clear, Florida's housing market was fueled by rapid population growth, and now that engine is losing momentum. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 9. Overbuilding is creating a silent supply glut. During the height of Florida's housing boom, builders couldn't keep up with demand. New developments were announced everywhere: sprawling suburban communities, high-rise condos along the coast, master-planned neighborhoods promising resort-style living. Construction cranes filled the skyline. It felt like growth would never slow down. But here's the problem. Many of those projects were planned and financed based on peak demand assumptions. Developers expected migration to continue at record levels. Investors assumed buyers would keep competing. And cities approved large expansions anticipating endless growth. Fast forward to 2026, and the reality looks different. Now, in several parts of Florida, there's more inventory hitting the market than buyers ready to purchase it. Builders are offering incentives, closing cost credits, mortgage rate buydowns, free upgrades, just to move properties. That's usually one of the first signs of softening demand. When brand new homes come with financial perks, resale sellers are forced to lower their prices to compete. Imagine trying to sell your home while a builder down the street is offering $20,000 in incentives and a reduced mortgage rate. Buyers naturally compare. That added competition creates downward pressure on resale values. And it's not just single-family homes. Condo towers and vacation rental properties built during the boom are adding even more supply. When listings pile up and homes sit longer on the market, sellers begin cutting prices. One price reduction leads to another, and soon, comparable home values start adjusting downward. For homeowners, monitoring local months of inventory data can provide early warning signs. If supply continues rising faster than demand, prices may keep softening. In 2026, Florida isn't just facing weaker demand. It's facing too much supply at the wrong time, and that imbalance is quietly pushing property values lower. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. Number 10. A psychological shift is changing the entire market. Here's something many people overlook. Real estate isn't driven by numbers alone, it's driven by confidence. And in 2026, confidence in Florida's housing market is beginning to crack. When headlines start talking about falling prices, rising insurance costs, and investor pullbacks, something powerful happens. Buyers become cautious. Sellers become nervous. And hesitation spreads faster than any storm. Think about how the market felt during the boom. People feared missing out. Homes sold in days. Buyers waived inspections. There was urgency. That emotional momentum pushed prices higher. But now, the psychology has flipped. Instead of buy now before prices rise, the mindset is shifting to wait and see if prices drop further. That single change in attitude can slow a market dramatically. When buyers believe prices might fall, they hold off. When sellers sense hesitation, they reduce prices. When multiple sellers cut prices at the same time, new lower, comparable sales are created. Appraisers use those comps, which further reinforces declining values. It becomes a cycle, not necessarily caused by one major event, but by shifting expectations. Picture an open house with fewer visitors than expected. Weeks go by with no offers. Then comes the first price reduction. Then another. The longer a property sits, the more buyers assume something is wrong. Perception becomes reality. For homeowners, this means understanding today's emotional market is critical. Overpricing based on yesterday's peak values can backfire. Pricing strategically and staying realistic matters more than ever. In 2026, Florida's property value decline isn't just about storms, taxes, or interest rates. It's about something deeper, a psychological turning point where fear is slowly replacing optimism. And when confidence fades, prices often follow. If you own a home in Florida, or dream of owning one, subscribe now before the next market shift catches you off guard. So what does all of this really mean? When you step back and look at the full picture, it's clear this isn't just one isolated problem. It's a combination of rising insurance costs, stronger hurricanes, flood zone changes, investor pullbacks, higher property taxes, mortgage rate pressure, condo regulations, slowing migration, overbuilding, and a psychological shift in buyer confidence. Alone, each factor might slow the market slightly. But together, they create something much more powerful, a sustained downward pressure on property values. For some homeowners, this may only mean slower appreciation. But for others, especially those who bought at peak prices with high leverage, it could mean shrinking equity or even negative equity. That's a scary thought, especially if you were counting on your home as your biggest financial asset. But here's the important part. Panic is not a strategy. Real estate moves in cycles. Markets expand, cool, correct, and eventually stabilize. The key right now is awareness. If you're a homeowner, review your insurance coverage. Monitor your local inventory levels. Stay informed about flood maps and tax assessments. If you're thinking about selling, price realistically and understand today's buyer mindset. And if you're buying, negotiate wisely and factor in the true cost of ownership, not just the listing price. Florida isn't disappearing. People will always want sunshine, opportunity, and coastal living. But 2026 is shaping up to be a year of adjustment. The homeowners who stay informed, stay realistic, and stay proactive will be the ones who protect their equity, and possibly even find opportunity in the shift.